Welcome to today's episode of Revolve Commercial Podcast. I'm your co-host, Samantha Riley, and as always, I'm joined by the expert in commercial real estate, Mish Daniel. Mish, it's great to be here with you again for another episode.
Love doing these, Sam. Love speaking to you and sharing as much information with the audience as much as we can. Thank you.
Absolutely. And like I was saying to you before we started recording, I love this. Every time we record, I get off and I run to my husband and say, "Oh, guess what I learned from Mish today?" It's so good because as everyone knows, I am not the expert in commercial real estate, and I love being here and asking you these questions because I feel like I'm the luckiest person. I get to ask you the questions that I want to know. So today I'm feeling very grateful that you're going to answer all sorts of questions. We're going to talk about cash flow versus accumulation. We're going to talk about property investment in education, obviously, in regards to commercial real estate, demographic shifts, diversification, the resilience of commercial real estate versus residential, and some of the biggest mistakes that people make in commercial real estate. So I think it's going to be a fabulous episode.
Yep, looking forward to it. And I'm just sitting here looking at the weather and thinking, oh my gosh, we're in Brisbane. We've had 4 seasons in one day already. Isn't that crazy?
Well, we have here in Noosa too, let me tell you. I was just thinking the same thing. It's very strange weather, but it's not just Australia. We're having some very strange weather all over the world.
I think we are.
Crazy.
And it's not only weather, I think it's financial circumstances. We're going through some as much as the weather changes, the financial dynamics are changing. So it's super exciting times. It really is.
Yeah, I like the way you say that because people can be fearful or they can realize that it is changing and that there's a lot of opportunities. So I'd like to dive in if it's okay with you. And I want to start off with talking about cash flow versus asset accumulation because this is something that I hear a lot about. People have got different ways of looking at this, different perspectives. I would love to hear from you. What factors should people really consider when deciding to prioritize cash flow over asset accumulation or the other way around? And what do they really need to decide to or when do they need to prioritize one over the other?
Very interesting question there, Sam. I think you've asked me about three questions in one.
Sorry, I do have a habit of doing that.
So let's just go through them and have a chat about them anyway. Well, I don't know about you, but I reckon that cash flow is king. So you know the old adage, cash flow is king. So whatever you're doing, I think the whole purpose of doing what we're doing is to generate as much cash flow as possible. And there is the strategy of negative gearing. I've never understood negative gearing. I still don't. I refuse to understand negative gearing. However, I do understand that there are certain people that earn too much and feel as if they pay too much cash. So they use that bricks and mortar, hoping that the property evaluates over time and they can pay off and use that against their debt. As far as I'm concerned, I find that very reverse type thinking because, in my opinion, you want to accumulate as much positive cash flow as you can. And a lot of people that I speak to have accumulated huge tracts of residential properties. I'll give you an example. There's one fellow in particular, he had 19 residential properties, of which 9 of them were negative. And yeah. And we had a look at the numbers and I said to mate, if those were negative, how much cash flow would you be making? So in other words, what you're giving away to the tax man, you could be putting into your pocket. Yes, you do pay tax. And the idea is that you mitigate as much as that tax as possible. And you could still be using that cash flow to be accumulating better quality properties and growing your cash flow. So the whole idea of accumulation is, I love accumulation, all right? And I say to everybody, the strategy that we do is the strategy of accumulation, but it's not a matter of accumulating properties that are going to be like chains around your leg. You want to be accumulating properties wisely so that you can use those properties to leverage against and build more, put more in your portfolio and accumulate better quality properties. So
I love it. So your answer really is both.
it is. It is absolutely.
Yeah. It's not one or the other. It's cash flow and accumulation.
Correct. And it's amazing because a lot of people are out there thinking they just got to buy residential, buy. Well, yes, if you can, but you're going to reach a ceiling. And if those properties are not yielding you positively, then why would you be buying them? To me, it doesn't make sense. So, often we would purchase commercial properties that aren't, especially in the current rates, because with the current rates where they are, they're at the top end of the market. I'd be saying to my clients, these properties are still good to buy. They might be at the top end of the market because the interest rates are coming down. So they might be just washing their face, so neck on neck, or maybe slightly negative by a couple of $1,000s a year. But we can see that within 12 months to 24 months, these properties are going to grow in value, and there's always added value strategies.
So if people are listening and they're holding negative value properties right now, and they've just heard this and gone, great, what's my next step? Is that having a chat with you specifically about those properties?
Well, I reckon that would be a very good move, is if not myself, somebody else, somebody who is real estate savvy, who is commercial real estate savvy. When you speak to me, I always say to people, I'm biased because I like commercial over residential.
Mm-hmm.
I think having residential in your property, in your portfolio, is very good. Don't get me wrong. But when I see portfolios that have got a lot of negative residential properties, I always ask, why would you try and run a marathon with a rock around your leg? So we'd have a look at those properties and ascertain whether those properties are going to grow in value or whether they're just stagnating. And if you can use those properties to leverage against getting good commercial properties that can give you cash flow, why not? So it's a matter of analyzing what's in the portfolio, and is now a good time to sell, is now a good time to hold on to those properties. I was chatting to somebody the other day. They had about 6 properties. One of them, he said, is never going to grow. It's in a bad area. The area is not going where he wanted it to go. And he made the decision. I'm not going to make that decision for you. You make the decision. And he said, yep, if he were to release that property, in other words, sell the property, he'd probably free up about $300,000. And plus he had about $600,000. So that would give him a really nice property. He could get into a $2 million commercial property, which is going to make him a good little whack of cash flow.
And cash flow. I just like that word. I like it. It sounds good. Well, let's talk about this a little bit more, because there is a lot of information available. People are making decisions like this every day. How crucial is it to have formal property investment education? Because there is so many variables, right? So how do you balance this theory of getting understanding this and getting the free advice versus the real world experience?
Sam, you know what? Information is key. Commercial real estate is such a massive topic because you've got so many variances. It is vital that you don't go out there thinking that you can do this without any assistance. Read books, listen to podcasts, be circumspect about what social media you watch, get educated, buy courses. And even that, I find a lot of people would do courses, they would go on social media, they would try and do a lot of this by themselves. And because there's a lot of nuances in commercial real estate, I really feel strongly that you need to have a mentor. You need to have somebody that you can speak to, somebody that's done it, a father, a grandfather, a professional, but it's such a huge topic. When those red flags come up, when those nuances come up, you need to have somebody that you can speak to, a pro, somebody who's done it, somebody who's going to give you the right information. Don't go to your accountant. Don't go to your broker. you know.
Yeah.
Don't go,
Right.
don't go to your hairdresser or your mechanic
Uncle Bob at the barbecue.
or your mate that you met at the bar. That's like, he's
Exactly.
know how to do this. Speak to those people for sure. Absolutely speak to those people. Pick their brains. Get as much information as you can from them. But when you're doing it for yourself, there's a 1, 2, 3 step formula, and you have to go through those steps correctly to know exactly what to do at what points and when to pull the trigger. You know.
Mm,
So there's when to pull the trigger, how soon, the negotiation, all of that. It really is a fine art almost. And
mm.
you've probably heard me say this a couple of times. When you're buying residential, go for it. Do it by yourself. Everybody knows how to buy a house. 2 steps and you can open the front door. Commercial real estate is like climbing Mount Kilimanjaro. There are just so many
Mm.
steps with a 50-kilo pack on your back. It's fun. It's very challenging.
Yeah, well, I think like going on that metaphor of Kilimanjaro and when you're climbing those big mountains, and I'm thinking of like, Mount Everest, you've got the Sherpas, right? That they carry your packs for you. And you could do it, try and walk up Mount Everest with the pack on your back and have to stop all the time, and it would take a really long time because it was really heavy. Or you could get the Sherpa to carry the bag for you. You're still walking the mountain, but you're doing it with less weight. You're tapping into someone else helping you make the decisions, so you're able to you know understand through the eyes of the expert that knows the weather patterns and so forth. And I think that's what having a mentor is like. It's like having that Sherpa to help you, because you don't know what you don't know. They're the ones that are not only helping you get up the mountain, but they're doing it all the time. And I know that that's something that, well, you've got the fast track commercial mentoring program. And I think that's what it's like. You're the Sherpa helping people to make this ascension up the summit.
I love that analogy. Yes, 100%. Yeah. I guess, yeah, we would be the Sherpas because we do all the lifting. We do all the heavy lifting. We do the punching and the carrying. Yeah, we offer a host of services. We do a very comprehensive online education. We do mentoring, and it's all aimed at empowering investors. I want to give back as much as possible. I love mentoring. I'm passionate about mentoring, about helping people, I'm passionate about commercial. So I love just talking to people about it and seeing them grow and prosper. And I guess the most exciting day for me is when somebody settles on a property. It's like, woo! It's
Mm.
it's amazing. It's like getting to that summit. So you get to the top of that summit and it's like, wow, we made it. Amazing. It's really
Totally, so good. I love that. Let's shift gears a little bit and let's talk about the shifts in the market, like in the marketplace, like aging population, changing migration patterns. We've talked a lot about that in the last couple of episodes.
mm.
How do these trends reshape the property markets? And I guess what opportunities and challenges do these shifts create, so that investors can like look out for those little signs and understand how they can future proof their portfolios.
Okay, so I guess in commercial, we're looking at, let's just go through aging population. What we find is a lot of people have got their commercial properties, maybe they bought them in their 30s, 40s, 50s, whatever, and they've hung on to these properties until they're in their 70s, 80s even. And these properties have really been cash cows for them because as the market moves, the rentals gone up, they've been amazing cash cows. Now they're at that age, and we see a lot of it sort of mid 60s, where people are wanting to sell down their portfolios, sell their businesses. And that, of course, is an opportunity for a buyer to go in there and buy really good properties. Sometimes those properties are old and tired, and there's leverage for negotiation at that point. In terms of following the residential trend, we see quite a lot of shifts in the market where we see properties changing, and it's almost like it goes through, almost want to say it's like a 20-year cycle where you'll have these little precincts that have been humming and buzzing and the residential is gunning it. And coming close to that top end of the cycle would be the 20 years, and the 20 years would be probably where your 40-year-olds get into business. They pump those businesses through until their 60s, and everybody wants to slow down in their 60s. And if they don't have successes, then that's when the business changes. So be very careful when purchasing a commercial property, when you're dealing with an owner-occupier who is heading into that aging population, who's heading into that retirement sort of era, because often they might put a lease back on the property, but they might be selling there. And I've seen this a couple of times. They're selling the business, they don't tell you about it, or they've got a successor coming in who hasn't really got the runs on the board to run the business. So again, I spoke earlier about nuances. This is one of the nuances you really want to know about, and having knowing how long that cycle is and where you are in that cycle,
Yeah, totally. Now, while people are listening to this, they may have already had questions pop up in their mind, or at the end of this episode, it may, as they reflect, they may have other questions. And I want to let people know that you do a weekly Q&A every Wednesday night at 7 p.m. on Facebook, on your Mish Daniel's commercial real estate. No. Oh my goodness. What is it? Mish Daniel commercial Facebook page. Oh my goodness.
We'll just drop a link into the notes.
That would be the easiest way to do it. But 7 o'clock every Wednesday night, and that's 7 p.m. Brisbane time?
Brisbane time, yeah. 7 p.m. Brisbane time. Just go to Facebook, have a look at Facebook. And if you're on the wrong Facebook, you'll see a link to go to the correct Facebook, because we got 2 or 3 pages going. So, it's a live Q&A. If you've got questions, send them in before. Just there'll be links. If you go to the Facebook and check that out, you'll see there'll be a link where you can send your questions in. And I'd be happy to chat to you live, online, about whatever the questions are that you have about commercial real estate.
Love it, love it, love it. So let's talk about diversification now. Diversification across states. This is something I'm really interested in. Diversification across different asset classes. How important is it? And how do you know when to push the button, how to manage the risk, how to, I guess, capture those growth opportunities?
Look, Sam, it's very much, and it's sort of what we did previously. In previous episodes, we tracked government spending. And we identified that there's government spending that's happening in most states over the next 5 years, 10 years. And the thought behind that is where the money goes, people follow. All right. So building out infrastructure is obviously where you're going to get development, where you're going to get people going. And the great thing is that this is happening right throughout all states. The advantage of that is you don't really want to be stuck in one state in specific. It's a good thing to diversify your portfolio because there are always changes. Their government changes, their state changes, their rules, regulation, taxation changes, land tax, stamp duty changes as well. I mean, Victoria's just made a change to their stamp duty. And of course, Victoria's needs to accumulate as much cash flow and taxes.
Big time.
Yeah, so they're throwing quite a lot of incentives out there. And I think Victoria's investment market has dwindled a little bit. So they're hoping that their incentive of stamp duties is going to help that. But I think it's really important to buy one of the 3 assets in commercial. So you've got your industrial, you've got your retail, and you've got your office commercial. A lot of people are saying office, ew. Well, actually, office is coming back. And depending on where you purchase, in which states, in which streets, which areas, make a huge difference. And the good thing about that is, again, that diversifying your assets and diversifying your states for all of those reasons. Regional as well as metro. Have a look at purchasing in regional. You'll get higher yields in regional. You'll get better value in metro areas. And the advantage of that is you'll probably get faster growth in your metro areas. Yes, your yields will be compressed, but you can pick up some really good assets. And in a time like now, you don't really want to be chasing yield as much as you want to be chasing value. You want to be buying good value properties because you know that those properties are going to be going up with the projections that we spoke about in one of the previous podcasts.
I'm just thinking about you were saying that office space people are sort of turning their nose up a little bit, and I think that's from the perspective that we all know. But the first thing that popped into my mind, and tell me if I'm on the right track here, is that something like, to me, medical would be in office space. And when I think about medical facilities, like, medical offices, I would think that they are going, not only are they not going anywhere, but I would imagine that they would be increasing as our population's aging in some areas?
It's a good question, good observation there, Sam, because what's happening in the medical sector is there are a lot of big international companies that are buying medical suites, and they're buying up medical GPs all over the place. So they're becoming corporate, and a lot of them are looking for new premises. A lot of them are purchasing existing premises, and we all know that medical always pays a lot more. So yes, they are office, but medical sort of is special use. We'd look at that as special use, just like childcare, just like storage, those kinds of assets. And I'm talking office, I'm talking about there's still a lot of
traditional office.
Look, I don't like buying traditional office anything further than about on the third floor.
Okay.
I think it's better value the closer you are, and it's all about land. So if you can buy office on ground floor or in shopping centers or something like that, you have a versatile multi-tenant sort of strategy. And you're wanting to be buying office where there's a hub, where things are happening, where they're supporting businesses, Yeah,
and that's why I love talking to you. You know the stuff. You've got the goods.
Absolutely. It's all about the market fluctuations, and think about, what are you buying for? Are you buying for long-term success, or are you buying for what is your landscape? What is your portfolio? So you're wanting to be building up a portfolio of that has got the resilience that can stand. So diversify as much as possible.
Yeah. Well, talking about the fluctuations there that you just mentioned, commercial and residential does respond differently to those fluctuations. What are some of the key factors that make commercial property more resilient or less resilient compared to residential?
I think, commercial is probably, I'm going to say it's less resilient. I want to say residential probably is more resilient because people always need houses, they always need homes. However, commercial has got that longevity in it because you're getting longer leases, you're getting higher yields. It might be a little bit more sensitive to the economic changes, but that is all a matter of management, making sure that you have the right management expertise behind that. So commercial estate tends to be a little bit less affected by that political scrutiny, where residential properties provide you stability and resilience during the economic downturn, but they've got lower returns, lower yields. And again, that's why I say diversify, buy both, have a couple of residentials in good areas where you're getting decent returns. If you can buy something, if you're going to be buying in residential, I'd say definitely try and buy something where you can add value, put a granny flat on, add extra rooms, rent out, whatever that is. A lot of people are buying shared accommodation. I'd say be careful with that. Again, it's how you manage it. But a good diversify your portfolio, which gives you a good balanced risk on both sides. And always, it's good buying residential first, so you kind of get to feel what it's like to be a landlord before you buy commercial.
Interesting. Okay, that's really good advice. Now, I know that you have almost like a commercial real estate magic wand where you can help people bring the properties to them so they can wave their magic wand and properties just arrive in their inbox. Can you share a little bit about what that is?
So this is just a little bit of helping the community. We run something called the VIP list, and it's about 20 properties a month that we put onto what we call the VIP list. It's properties that we look at, it's properties that we check out, and maybe we're not going to use them. A lot of these properties are auction properties. So if you're in the market and you've got the grit to do the auction, then hell, go for it. They're great properties. So we've got two versions of it. There's an unpaid version where it just gives you sort of the highlights of the property, and then there's a paid version that gives you everything. It gives you the links, the IMs, gives you a little bit of information on the property. And again, I would say if you don't have a mentor or education on your side, then yes, you can check these properties and have fun with them. I always say to people, this is a little bit like paper trading in the stock exchange. Use
Okay.
lists. When you come on board, check the lists out, pick properties off there, use these lists to learn. If you're an experienced investor, this is a great list for you to see. And these are properties that are delivered to your door that we've looked at and said, yep, that's a great property. I know quite a lot of our students and our people that have said, Mish, we bought that property that was on your VIP list. And I thought, whoop, yay. Because
Excellent.
yeah, that's the whole reason for doing it. So,
So
guys,
if you'd like to, yeah, totally. So if you'd like to sign up to the VIP list to have those properties arriving in your inbox each month, then the link will be just below so that you can do that. Now, Mish, we've talked about a lot of mistakes that can happen. If you could summarize like what the common mistakes investors make in commercial real estate and how can we avoid these mistakes or pitfalls to make sure that we can have that long-term portfolio or that long-term success?
I see this happening classically, daily, seriously. The biggest mistake that people make is they overpay for their properties. So they'll see a property and they will base it on the rental income or the yield, and they'll say, whoop, this property is yielding 7%, 8%, 9%. Wow, that's amazing. And there's an incremental increase on the lease, and the tenant's been there for 10 years. Yes. And they go out and they buy the property. What they don't do is check the market relative rates, where that tenant is on the cycle, where the market reviews are going to be, and what the longevity of the tenant is. So this is probably the most painful experience, that if you're buying commercial properties and you're seeing those high yields, question why. Okay, it's a red flag. They look fantastic, they're awesome, but it's a red flag. The only high yielding property that you should be buying is perhaps regional. If you're buying regional, you want to be buying high yielding properties because your risks are higher, your population's smaller, there's a smaller pool of tenants, so you want to be buying high yielding properties. So the other thing I've seen a couple of people mistakes that they make is they get sucked into auctions. And I said to you earlier, we don't do auctions for, and this is one of the reasons. We'll buy before auction or we'll buy after auction. Reason for that is because there's that whole hype, everybody gets into it.
Gets so caught up in it.
Yeah, and it's like, whoa, it's like being on a foofy slide and you can't get off. you can't get off until you smash into the water at the bottom. And it's great. Gee whiz, I've just bought a property on auction. Gee, that was fun. Oops, I've just bought it at 4.5%. We've seen this happen a couple of times, particularly with the big branded tenants, fast food chains, the McDonald's and the not really McDonald's, it's more KFCs. We see a lot of those drive-throughs, childcare centres. they sell for millions more than what they're worth because, again, your rentals are inflated. Do your due diligence, run your numbers, do your market research, and make sure if you're going to be buying them, you've got to have a top end and a bottom end when you're going to auction. So maybe 5% above your switch off price and 10% below. Happy days.
What's your thoughts on if you really want to, if there's a property that it's really caught your fancy, it's at auction, what's your thoughts about using a buyer's agent to go to auction for you?
Always a good thing if you've never done auctions before and your buyer's agent has got experience on auctions, that is an option. It's a bit difficult for the buyer's agent to be doing the bidding for you, and there's certain protocols that you need to set up before that. So there's quite a lot of preparation in order to do that. What I've often done is I've said to my client, you go to auction, so they sign in for all the protocols and everything, and then we have a dual call going on. So I've got the auction going, she's got the auction going, and then we've got a call, and I'm speaking to her through the phone and telling her where to bid, what to bid, how to do it, him or her, whatever, and just assisting on that auction, assisting her with making the bidding. Yeah, they're tricky. You find that I reckon 90% of properties that go to auction sell for 10% more than what the market is.
There's a good little reminder there to really know your numbers and speak to someone who knows what they're doing.
Yeah, and I'm going to throw a little, it's a little bit of a backpedal in over here. It doesn't mean to be a back. On the auction, sometimes you can be buying those properties for a little bit more. I don't like to go as high as 10% more because generally, depending on the asset, depending on what type of property, if it's a distressed property, then I'd say go for it. If you know that you can make that money back within the next 6 to 12 months, buy it. But if you can't, if it's an established branded tenant and there's no chance of you making that money back within 12 months, pull out. Really, other assets. You can spend your money better in other places on other assets than being caught in something like this and overpaying. Then you've got to sit and wait 3-4 years before you get that money back.
So you're talking about timing there. What's your thoughts on investing in commercial property now? Do you think it's a really good time now or not as favorable?
Hey, Sam, you're speaking to somebody who thinks that every day is a great day to buy property.
Tell us why then. I need to know why.
Yeah, look, I do think that now is a very good time to be buying properties because we all know, and the talks on the street, that we've seen the end of the rising interest rates. The interest rates have been holding tight for quite a long time. I think there have been a lot of people that have been pushed out of the market that haven't been able to buy while those interest rates are going up. Now, the possibility is that those interest rates are going to come down, and I reckon there's going to be a flood of people that are jumping in and are going to be buying assets that have been sitting on the market, that have maybe been hurting. There people have been sitting on their assets and haven't really been able to afford them because of the highest interest rate or higher interest rate. So now's a great time. If you've been sitting in the wings, is a brilliant time. It's a window of opportunity before those interest rates come down. So it's just very favorable buying conditions to be purchasing, allowing us to secure better deals. And I'd say probably better than what we've had in the last 12 months. The last 12 months have been a bit tough. So I reckon, buy now, jump in, grab the window of opportunity.
I love that. So for people that are thinking, yeah, okay, I want to grab that window opportunity, but I don't really know enough about it. I think for me, something that I always do when I want to learn more about something like that is to be around like-minded people, to be around people that are having those conversations already. And I know that you do some monthly meetups or some live events around Australia. You've got one coming up in Melbourne towards the end of October. You've got Sydney, I believe, in November. How do people find out about those meetups and to really immerse themselves in that? Having the conversations that people that know.
Look, I think the best is to go to the app Meetup and just look up Revolve Commercial, Mish Daniel on the live events, and you'll get all the information there. We'll also be posting a lot of it on all of our social media pages. So follow us on the social media pages. You'll get the times, dates, places, events, all of that. This is something that we have started again. We used to do it pre-COVID. So and by popular demand, a lot of people are asking us to please come back and visit them in the various different states. So I've decided to start those live events again and to immerse yourself in the community, immerse yourself in the commercial real estate realm of everything that's happening. Ask questions, bring them along with you. I'm trying to create a platform where people can converse, speak to each other, do deals together,
Love collaborations.
Yeah, collaborate, do stuff together, learn how to do this. I've got a couple of people in the group where I'm mentoring one person and they've got 2 or 3 partners, but they're the working partner. And then the other partners are finance. They work on finance or they're working on legals. Got one group that the one guy is handling the finance only, the one's doing the operations, and somebody else is doing all the legals. So just work on your strengths. It's a great time to be doing it. It's a great opportunity. So.
You did mention earlier the Fast Track Commercial Mentoring Program. I didn't want to finish this episode without, I guess, letting people know a little bit about this, because there are going to be people that are listening that are like, no, I'm fully in. I just want to make sure that I've got the right mentor so that I can do this well and have their hand held through the journey. So I know that you're going to put the link below so that people can look into that, but can you just share a little tiny bite of what people can expect from joining the Fast Track Mentoring Program?
Yeah, so the Fast Track Mentoring Program is a full gestalt of everything in commercial real estate. So we would be offering the online education. That's roughly 12 lessons, 60 modules. And there's videos and there's examples and there's case studies and everything right throughout that. What you also get is group mentoring. So one of the Facebook sites where you get group mentoring, you can jump in there and ask questions and say, and post your deals in there. Put your deals in and say, hey, I'm busy doing this deal. What do you think of it? Or this has happened, or that's happened. Or for instance, we've just got a client that's been battling with the seller who doesn't want to give them access to the tenants. He doesn't want, the seller has said that the buyer cannot speak to the tenants. Well, that's a huge red flag. So we discussed that and how to do that and how to work around that and that kind of thing. Yeah, it's a very collaborative space. We would invite you to come to the meetups, depending which state you're in as well. So you get access to the meetups, you get access to all of that education, and you get access to myself. I will be doing once a week with all of the students. I'm on there and you can fire your questions and throw your properties at me and I'll do them live with you. Boom, boom, boom. And what else? You can have, it's 2 hours of one-on-one mentorship with me a month. So get your ducks in a row, know what you want. You've got the online platform, which we can speak about generally, but if there's specific things that you want to speak to me about, you just book a time and you can accumulate that time. So it's a 12-month program. You can accumulate it if you want to accumulate it. And when you get onto a deal and you think you need 6 hours of accumulated time over a certain period, maybe month 3 or month 4 or month 5, then you can do that as well. So it's very flexible. And this is all about giving the audience the opportunity to make this work, okay? To do it as functionally as possible. I'm trying to give back as much as possible because I want to see runs on the board. I want to see people prospering, doing this and succeeding at what you're doing over here.
Love it, love it, love it. So everything that we've talked about today will be wherever you're listening to this episode, the links will be just below. So scroll down, you'll find the links to the social media platforms for the Q&A, the fast track commercial mentoring program, the live events, all of it, everything we've talked about. Mish, I want to ask one final question to round out today's episode. What is one thing that you want people to take away from this episode and really think about?
My takeaway would be it's a hairy bear if you try and do it alone. My takeaway would be get educated, get help. Buying commercial real estate is the best thing I have ever done in my investment journey. And I would like to share that with most people as possible. So if you've been thinking about it, just do it and do it now, because I speak to so many people who think about it and think about it and think about it. They come back to me 3 years later, 2 years later, and they've missed out on so much. And when I work out, show them how much cash flow they've missed out on, it's unbelievable. You know, if you're sitting on a pile of $400,000 right now and you're not investing right now, you're missing out on between $60,000 to $70,000 of cash flow a year. So if you're leaving that for 2 years, it's $140,000. If you're leaving that for 3 years, that's what? $210,000 of cash flow that you're missing out on. That's how big it is.
Yeah. The best time to plant a note tree was 20 years ago, but the next best time is now. So do it.
Love it. Absolutely.
Mish, thanks so much for joining me on your show. It's been I've really enjoyed everything that you've talked about today. Thanks so much. And we'll catch you on the next episode of Revolve, a commercial podcast.
Thank you, Sam. Always a pleasure to be having these chats with you. Thank you for the time.